Welcome back to The Deep Dive. Today, we are digging into one of the big ones, the Q4 and fiscal year 2025 earnings call that dropped just after the market closed on Wednesday, December 10th.
And this call, it was really defined by this central tension, this push and pull.
Absolutely. On one hand, you had just phenomenal execution from the company. The financials were strong, disciplined, and they showed real hard data on AI adoption.
But on the other hand, the market was, completely unimpressed. Investors showed up demanding clear proof of growth acceleration, and just a solid beat wasn't going to cut it.
That dynamic is really the whole story here. You could feel management on the call just trying to hammer this one point home.
What was that?
That they are a foundational, an indispensable player in the global AI ecosystem now. They're trying to shift the narrative.
It's a multi-year pivot, really.
Yeah.
They kept using this phrase, an AI and agentic platform company. And that agentic part is so critical for you to understand.
Right, because that's about the future. It means optimizing everything they do for conversational AI agents.
Exactly. For the automated assistants, the LLMs that are going to increasingly search and consume and even buy things on our behalf, they're basically fighting to stay visible in a world where you don't just click on a link anymore.
Okay, so let's unpack that. Let's start with the immediate headline numbers, because the business itself is, undeniably healthy.
It is. This was a clean beat, top and bottom line.
Non-GAAP earnings per share came in at $5.50. That sailed right past the consensus, which was around, $5.39, $5.40?
Yep, about a 10-cent beat. And revenue did the same thing, hitting $6.19 billion. The street was looking for something closer to $6.10 billion.
So that's a really solid 10.5% year-over-year growth. If we just stop the deep dive right there, you'd say great company, great quarter.
You would, but you can't stop there, of course.
No, because the market reaction is where the whole story, that whole tension gets revealed. Despite the beat, the stock traded down about 0.7% after hours. Basically flat.
It's almost a non-move. It is the dictionary definition of a muted response. And you have to understand, before this report, the options market was pricing in a huge swing.
How big?
An implied move of 7% to 7.6% in either direction. That was the bet traders were making.
So the fact that it barely budged.
It means all those bets on a big move were just dead wrong. It created what we call a significant implied volatility crush.
Okay, so all the money that traders paid for that short-term protection or for that big pop, it just vanished into thin air because nothing happened.
Precisely. It tells you the bar was set impossibly high. They didn't just want to beat. They wanted a narrative-changing, explosive guidance raise, and they didn't get it.
So let's zoom out a bit then and look at the foundation they're building on, because the full year numbers really do reinforce that execution story.
Oh, they do. For the full fiscal year 2025, you had record revenue of $23.77 billion. That's up 11% year over year.
And non-GAAP EPS of $20.94, which is a very strong 14% jump.
And this isn't growth at all costs. This is the key part. Operating cash flow for the year topped $10.03 billion. That's the engine. That massive, reliable cash flow is what lets them make these big all-cash acquisitions we're going to talk about. And
the main metric they're pushing now is annual recurring revenue, or ARR. Total ARR for the company left FY25 at $25.20 billion. That's up 11.5% year over year.
And that subscription model is just so durable. It's now $5.96 billion of revenue in Q4 alone, growing 12% year over year. But what was really interesting to me was how they started tying these numbers directly to AI feature adoption.
Yes. Let's get into those explicit AI metrics, because this is where that execution story really comes to life.
Okay, so generative credit consumption, that's basically the currency you use for Firefly and their other AI tools. It grew 3x, 3 times, quarter over quarter.
That's a huge acceleration in usage.
Massive. But you have to ask the right question.
Which is, how much of that is just free trials? Is it actually turning into money?
Exactly. And they tried to answer that. They said, first-time Firefly subscriptions doubled quarter over quarter. So yes, that experimentation is converting. And even more, they said total AI-influenced ARR is now over a third of their entire book of business.
So they're making the case that AI is now totally central to their monetization, not just some, fun side project.
It's not just fluff, yeah. And the audience numbers back that up. Monthly active users, or MAU for Acrobat and Express, the more accessible products, blew past 750 million.
Growing 20% year over year, that is a gigantic funnel.
It is. And for the really high value stuff, the creative premium offerings, MAU grew over 35% year over year. The momentum is just It's undeniable.
And you saw it on the enterprise side, too, which is where the really big contracts are.
That's right. The adoption of Acrobat Studio was the key signal. They said nearly half of all their big commercial enterprise renewals in Q4. They already upgraded to the Studio offering.
Which tells you there's real demand from big companies for these AI-powered document tools.
Okay, let's pivot now hard to strategy. Because the new products and partnerships are all about trying to own this agentic web concept.
First big move was basically opening the gates. They launched Photoshop, Express, and Acrobat apps directly inside of ChatGPT.
This is a huge deal. They're deliberately putting their tools right in front of hundreds of millions of conversational AI users. It's a massive, low-friction way to get new customers.
And besides that big partnership, they launched a bunch of their own agentic tools.
They did. Things like Acrobat AI Assistant, PDF Spaces, and this whole suite for enterprises, LLM Optimizer, Sites Optimizer, Brand Concierge.
Tying it all together, these are tools to help brands get found when an AI is doing the searching for a person, right?
That's it, exactly. How do you make sure your brand gets recommended by the AI? You need these tools.
But the really big enterprise initiative, the one that got my attention, was Firefly Foundry and Gen Studio. This feels like a totally different business model.
This is the paradigm shift. This is what investors need to be watching. Foundry is about delivering custom proprietary AI models trained only on a client's own data, their own brand catalog.
So you're moving from selling a generic software license to
selling a customized proprietary AI service. It's a massive, massive shift in the value proposition.
And they gave one single data point on the call that, for me, just perfectly captured the economic potential here.
The media and entertainment company example, it was staggering. This client already spending $10 million a year on their core products.
A huge customer already.
A huge customer. They decided to buy an additional $7 million in Firefly and Foundry services.
So a 70% step up in contract value, driven entirely by this custom AI stuff.
A 70% step up. This isn't just adding a few more seats. This is a complete replatforming of how that enterprise is spending money on content.
That one data point is the whole blueprint for the acceleration story they need to sell. If you can do that over and over,
then the low double-digit growth story is completely obsolete. It changes the conversation from how many licenses can we sell to how much of our proprietary service can we embed in your workflow.
Which brings us to their other huge strategic move, the $1.9 billion acquisition of Semrush.
Yep, an all-cash deal, expected to close in the first half of fiscal 26. And it plugs directly into that agentic web strategy. Semrush is all about SEO and what they're now calling GEO, Generative Engine Optimization.
So it's about owning that whole funnel, from getting discovered by an AI to creating content to delivering it.
That's the plan.
Okay, so all of these moves, Foundry, the ChatGPT deal, Semrush, they're all aimed at driving higher growth. So why isn't the market buying it? Which brings us to the investor context.
Well, the stock's performance has been, to put it mildly, incredibly frustrating for anyone holding it.
Down 37% over the last 12 months.
Yeah, and during that same time, the S&P 500 was up, 14, 15%?
And the tech sector ETF, XLK, was up 23 to 25%. So a massive underperformance.
Right, and that tells you something. The stock is trading like a Ferrari stuck in second gear.
Everyone knows it's a high-quality business, a great engine.
But they're just discounting its valuation. It's sitting around 20-time forward earnings because they need proof before they're willing to step on the gas and re-rate the stock higher.
And that skepticism really came to a head around the guidance for fiscal 26, didn't it?
It absolutely did. Management guided for total revenue next year of $25.9 to $26.1 billion. That's about 9% growth. And they targeted ending ARR growth of 10.2%.
And there it is. 10.2% ARR growth is the target. But they just posted 11.5% for this year. That deceleration, even if it's small, is exactly what the market seized on.
That is the core contradiction right there. Now, management pushed back hard. They emphasized that 10.2% growth still means about $2.6 billion in absolute net new ARR.
And they made a point to say that's the highest dollar amount guide they've ever given at the start of a year.
They did. They're saying, look at the actual dollars, not the percentage. But the market is being pragmatic here. They're saying if AI is this revolutionary force, it should show up as percentage reacceleration.
So investors are just waiting for that clear, sustained proof, the proof that these new AI tools can get them back above low double digits before they're willing to pay a higher price for the stock.
The execution is there. The inflection point in the growth curve is not. Yet.
Okay, let's shift gears for our final segment. And this is where we have to remind you, we are not financial advisors. This is not financial advice. We're just exploring the source material. Always do your own research.
Right. But if we were, say, an aggressive hedge fund analyst pitching an idea right now,
An outrageous but plausible trade idea.
given that frustrating stock performance, the solid results, and that huge 7% volatility crush, I think a directional options play makes a lot of sense.
You're saying the market just gave us a cheap window of opportunity?
It did. The simple strategy is this. You sell the near-term fear, and you buy the long-term growth story.
Okay, what does that look like specifically?
Specifically, the pitch is to initiate a long-dated call spread that expires way out in early 2027. You buy a call option that's significantly out of the money, targeting a price that would mean the stock re-rates back to, say, 30 times forward earnings.
And how do you pay for that big aggressive bet?
You help finance it by selling an at-the-money put option that expires sooner.
So the goal is to get a huge payout if the big catalysts for FY26 actually hit,
Right.
if the Semrush deal closes, and more importantly, if we see hard evidence that Gen Studio and Foundry can deliver sustained high growth.
To sustain 25% or greater ARR growth on those products, yes. If that happens, you trigger a multiple expansion, and that trade pays off massively. You're betting on that 70% step-up data point, not the current guidance.
An aggressive, thesis-driven trade. I like it.
It's all about that narrative shift.
Okay, so to wrap up this deep dive for you, the company is delivering robust financials, strong product adoption, especially in AI, but the market is just laser-focused on one thing: the rate of growth acceleration. And that's creating this narrative gap that's holding the stock down.
And that brings us to the final provocative thought I want to leave you with. This shift to the agentic web and custom models like Firefly Foundry, it's a massive land and expand opportunity. If that one anecdotal data point, that 70% incremental spend, is repeatable, Foundry could completely change how enterprises spend money on marketing and content.
Shifting from software licenses to high-margin AI services.
Exactly. So the question is, how much more room for growth is there above that current 10% ARR target if that shift really takes hold? The growth rate of Firefly Foundry and Gen Studio ARR isn't just a metric to watch in FY26.
It's the only metric that matters.
The only one that's going to expand the multiple.
The one that could finally unlock that frustrating share price. That's all the time we have. Thanks for joining us on The Deep Dive.